Christian, there's a lot of ETFs out there. What makes Amplify ETFs different? And then we'll talk about what's working.
Well, we really have a balanced product line, Greg, with about 30 ETFs and $10 billion. We have everything from covered call ETFs that seek to mitigate volatility but produce high attractive income to Bitcoin covered call ETFs and even the first blockchain crypto ETF that's been around since 2018. So we really have a gamut of ETFs depending on your investment need or challenge.
Well, let's talk about your covered call ETFs because those have been very popular in this current volatile market. How do you balance income generation with long-term growth? Because it's not mutually exclusive, right?
Yeah, well, some covered call ETFs, they write away all your equity upside. And what we seek to do in our ETFs is really have a tactical approach to covered call writing. So you own a basket of equities that are generally dividend paying, and then tactically, the manager can write covered calls on individual securities. So you kind of have the best of both worlds, above average current income from dividends and covered calls, but also upside or capital appreciation over the long term because you haven't written all your portfolio away on a given month. So I think that really separates these types of products. And in addition, in this turbulent market time, you have three sources of return, not just price appreciation. You have dividend income and option income. By the way, option income increases as market volatility increases, one of the only ways equity investors benefit from increased volatility.
But there's so many covered call funds out there. Let's just dig a little bit deeper into two of yours. You have the DIVO, the DIVO, and the HCOW, HCOW.
Yes.
Tell me about those and discuss why they're different from the rest of the pack.
Yeah, so DIVO is an actively managed ETF. It looks at high quality US equities, generally companies that are growing their earnings and growing their dividends. And then the manager has the ability to tactically write covered calls on individual securities. So this allows you to be really flexible based off market conditions. If VIX spikes, you see more covered call activity because there's more option income. If we are in a more of a calm environment, there's less covered calls and you get the chance to earn those dividends and have increased capital appreciation. So DIVO is really our flagship fund and is a replacement or complement to core or traditional dividend strategies. On the other side, we have an index-based product that looks at free cash flow companies. There's a lot of free cash flow ETFs that are popular, but adding a component to a systemic option writing portfolio plan. So in that sense, the ETF actually writes covered calls on a monthly basis to generate sizable income. So a traditional free cash flow ETF would yield maybe around 3%. An HCOW product that has a covered call overlay might yield 8 to 9%. So you more than double your income while still owning these high free cash flow stocks.
Can you talk more about the importance of income, especially during a volatile period? We've seen the transfer or the baton being passed from growth to value stocks now. Is that playing into this whole thing?
Yeah, for sure. So, when your only source of total return is price appreciation or depreciation, these types of market environments are tough. If you have kind of two other shock absorbers to that total return equation, dividend income and option income, you can really weather the storm. So, you see those types of return sets, dividend and option income, be able to offset some or all in some cases of the depreciation we've seen. So a great way to weather the storm over time in a market cycle.
And then finally, what about international stocks? If there's one thing we've seen from 2025 so far, it's also the transfer not just from growth to value, but from domestic to international stocks. What are you doing along those lines?
Yeah, so we have our iDevo product that essentially looks at high quality international companies, ex-US, and specifically focuses on dividend paying companies and allows the manager to tactically write covered calls as well. And that fund is actually positive on the year, gives you access to high quality companies that again have multiple sources of return from a portfolio standpoint. And many advisors traditionally are saying over the last few years, I have international exposure. Half the S&P's sales are from international markets, but we've now really seen the disconnect in performance from international indices versus US, as much as 10 to 15% difference. So advisors are now starting to have at least increase their international allocation or maybe start one again. And we think that's very appropriate. We just think looking at a high quality version when it comes to international makes a lot of sense.
All right. Well, thanks a lot for coming on and talking about it.
Great to see you, Greg.